Hey everyone, welcome back to Yuri's Box. In this video, I'll be talking about TLT. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So again, as usual, the summertime is my busiest time of the year. I just finished my sommelier exam. Got my wino license, if you will. So I got that out of the way. I have a lot of things in the pipeline. So again, I'll try to at least make one video per week. Really, as many videos as I can. All right. So when looking at TLT in this video, I'll be really kind of flipping the script, if you will. I'll be looking at TLT first and talking about some fundamentals on the chart. And later on, we'll be looking at some economic data that we got this week. So again, best place to start again is the chart. And again, you'll notice that, again, generally speaking, where do I see TLT going in the future? I see it going up, right? That, to me, hasn't changed one bit. And again, it comes back to kind of the fundamentals of the economy. I spoke about that many times in my previous videos, and I'll be going over that later on. As far as the chart is concerned, we've been in this kind of falling wedge formation for quite a while. And really, the question we have to answer, or the TLT has to answer, is will we have a sweep of the previous low that we had in 2023, as in July of 07 when comparing to the low of June of 06, or is this the low we've been looking for? The low in May of 2025, May 19th, similar to the low that we saw in January of 2011 compared to the low in 2010. All right, that is really the question we have to that TLT has to answer. And again, if we were to have a sweep, it could kind of look like, again, what we've been doing now, with kind of a fake out to the downside and then potentially a breakout, which is definitely not uncommon. You tend to see many times, whenever these chart formations take place, the first move is kind of usually a fake out. Again, not always, but sometimes that occurs. So I could see that happening. Having said that, it doesn't have to happen. I'm not being too deterministic about things and saying that, we have to have a sweep of the previous low. We don't have to have a sweep of the previous low. For instance, if economic data starts to kind of, continue to point to the downside, to me, it just lowers the chances of, a sweep occurring. Having said that, you also have to consider that the bond market has been hell-bent on pricing in higher inflation, stagflationary environment coming up. And again, and the bond market can go on a long time, having, going on a mind of its own, pricing in whatever it thinks it has to price in, only to have to reverse course later on in a dramatic fashion. We spoke about this many times before. If you look at, for instance, what happened between October of 2022 and the summer of 2023, rates went down and slightly sideways. And this was really why, the reason behind this was because, again, the bond market was pointing towards a recession. What it basically was saying is that, yeah, we hiked rates this much, but just you watch, we're going to have a recession and rates are going to have to come falling back again. Of course, we didn't have a recession at all. And so rates had to catch up in a dramatic fashion. After that, we had, if inflation is well behaved, rates can come lower. Inflation was not well behaved after that, and it had to catch up. Then we price in higher for longer. We go into an environment where we have a growth scare. They reverse quite quickly. Then we have, port strikes, fear of port strikes, natural disasters that, push up demand because you have to rebuy and rebuild whatever got destroyed. You have tariff front running. You have some presidential election euphoria, rates have to reverse course. And again, now I would argue from April up until now, we've been really discounting a stagflationary environment where you have bonds, especially on the long end, quite high levels, where levels not seen since October of 2023, without the growth of we saw in 2023, and the dollar potentially pricing in a low growth. All right, so you have kind of the stagflationary trade taking place in the dollar and bonds. That's to be confirmed, but that's just my kind of hunch, if you will. As far as, again, going back to TLT, again, just because the bond market is acting in a particular way doesn't mean that you should take that to the bank. In either case, right? So do keep an open mind. The bond market can stay, crazy. The longer you can stay insolvent, if that's another way of putting it. It can stay in its own mindset for a long, long time, meaning that we could see a sweep of the previous low, all right, defying even some of the fundamentals that we're seeing coming out, as as far as economic data is concerned. But at the same time, also, the economic data could just continue to point down, not leaving really much more room for TLT to go down, really just, kind of smacking the bond market into place, if you will. And again, I am quite, harsh with the bond market. But again, I continue to come back to this idea that, this narrative that the bond market is all seeing, it's great, it's practically the Wizard of Oz, the bond market knows everything, and the stock market is just a bunch of chimps in a zoo. But in reality, if you just look at history, so far in this cycle, if you just followed the stock market, you would have made millions. All right. And if you followed the bond market, you would have lost everything. It would have been, you would have been chopped up in God knows how many narratives. All right. Recession, higher for longer, rates coming down, higher for longer, recession, stagflation. All right. So keep that in mind, right? That's what I'm trying to say here. Let's assume for a second that we don't see a sweep of the previous low. And we actually do see potentially economic data come out. We see, for the downside, and actually that provides, the fuel that TLT needs to break out of this wedge. If you actually just, roughly speaking, take the high point here, which is $101, to the low point of April 2024, the starting of the lower part of the wedge at $87, that roughly puts you, at a $14 difference. Let's say we break out in August of 2025. $14 would put us at $90, 104, which more or less, all right, more or less speaking, it would equate to, realistically a retest, in my opinion, of this trend line right here, which was kind of my first target, if you will, for TLT. Potentially a retest of this previous trend line right here. As I always say, trend lines are meant to be broken on the downside and on the upside. And if we do see, something worse than, a scare occur, then you could start consider, only then you could start to consider, 135, which would be, again, a retest of the neckline of the head and shoulders pattern that we saw play out from 1929, from 2019 to March of 2022. All right. Not always, but again, sometimes, price action likes to revisit kind of these levels right here. In this case, particularly the neckline of this head and shoulders formation. So again, if we were to see, everything play out well for TLT throughout the summer, which again has been my kind of, I've been focusing a lot on the summer. I've been hammering that ever since I started making videos in February. Eyes on the summer. Keep your eyes on the summer. And again, if that continues to play out, my first realistic price target would be around, 104, 107, 108, give or take. Which again would also be, a revisit of this local high, these local highs right here of 2023, which would cause, would actually be some really pose rather some resistance around this level right here. All right. Simply because, again, we have the peak, it corresponds to the peak of 2010. All right. You have, some price action right here at, in 2013 as well. And right here in 2022 and 2023. So again, to me, my first kind of line in the sand, if we do actually break out, which is a big if, would probably be anywhere around, $105, $108, somewhere like that. All right. So keep that in mind as well. And that's pretty much it as far as the chart is concerned. Again, my base case for TLT has not changed. I've always been of the opinion that we will not see spikes. We will not see TLT spike up, unlike COVID. All right. Because this isn't an environment like COVID. This isn't an environment where, you have everything happening in a matter of weeks. We're not going to have this. All right. This skyrocketing of continuing claims and initial claims. It's going to be a process, as I've been saying many, many times. It's going to take time, and you're going to need a lot of patience because of that. And arguably, you could say that is exactly what we've been seeing. A lot of people were, in the market, kind of wanting this immediate gratification with, tariffs being bad news for the economy. Then we're going to have a recession in a month's time. Otherwise, it's all going to be good. Not really. Not really. Everything needs time kind of to permeate and work through itself, the economy. And so again, it's going to be a process. Of course, if we do see some economic data, point to the downside, like we saw last year, the first week of August, with that growth scale, with that bad employment report, then of course we could see some, bumps up. All right. Particularly, and probably this is a good place to segue to the economic data, initial jobless claims. All right. They continue to be at these cycle highs. And again, the drill, anything above 220, to me, that signals that we're likely to see unemployment rate going up in the next report. Anything below 215, you can expect the unemployment rate to come down. And today's number was 245, down from an upward revised 250 of last week. All right. What does that tell me? It tells me at the very least, the unemployment rate is going to go up by 0.1%. All right. At the very least. The last time we saw these kinds of numbers was last year in the month of July, and we saw a 0.2 increase in the unemployment rate. Now, again, you have shenanigans in the labor force participation rate. Okay. But keep that in mind. And again, if we were to see, again, a 0.2 increase in the unemployment rate, it will take us to 4.4%. Let's say we have non-farm payroll number come in slightly below expectations, not a great number, not terrible, but not great. Then yeah, TLT could probably go up, and it would actually kind of be a repeat of, this candle right here. All right. So again, this is kind of to finish off the chart part of as far as TLT is concerned. So again, my base case hasn't changed. Keep an open mind and something on the side in case we do see, the bond market continue to price in this stagflationary environment, which again is not my base case, but the bond market has been hell bent many, many times throughout this cycle in pricing in things that haven't happened. All right, a recession in 23, higher for longer in 24, whatever, a growth scare, then stagflation now. All right, pick your poison. So again, it's going to be a process. It's going to take time. be patient, right? That's the moral of the story, if you will. And so just going back to two initial jobless claims again, 245, not a great number. Again, historically speaking, we're still far away from the lows that we saw in '06. Again, if we saw 285 now, everybody would be pissing their pants, all right? Because it would be a terrible number compared to, the lows that we saw in 2022, 190K, 193K, 200K, all right? But having said that, if you compare it to pre-pandemic levels, we're moving away from those levels right here, all right? Same thing for continuing claims, all right? This isn't really updated. The latest number was 1.94 million, I think. But regardless, we had a breakout right here. I spoke about this in my previous videos, just pointing to the fact that this was begging for a breakout. We got it. And again, what does continuing claims really tell us? More of the same. If you put continuing claims together with the quits rate, you kind of get the whole picture, in my opinion, of what the state of the labor market is. What does the quits rate tell you? If the quits rate is at cycle highs, labor market participants are telling you that they see abundance in the economy, they see labor demand going up, and because labor demand is going up and probably supply isn't keeping up, employees have the leverage, meaning that they can use that leverage to either switch jobs for a higher pay, because again, there's a lot of demand out there for labor, or they can stay at their current job and use the potential of going to another job as leverage for really to ask for a higher salary, to ask for a raise. Okay. The opposite is true when the quits rate is at cycle lows. Labor market participants no longer see the abundance that they saw in the economy, meaning probably labor demand has slowed down quite a bit compared to where we were in 2022. You're likely to see wages, at the very least, not explode up as we saw in 2022. All right. The peak was roughly 7%. Currently, we are more or less at 2008 levels, ironically enough, and close to pre-pandemic levels. So something that is more normal, right? We're far away from 7%, which again, in turn, means any bout of inflation is likely to cause compression in margins, both at the household level, if you will, and corporations. Household, why? Well, if you have to buy something like a car and that price of the car goes up, you just have, and really the wages stay more or less flat, right? You don't have that increase, that dramatic increase that we saw back here in wages. All that's going to do is diminish the amount of cash you can spend on everything else. So again, I've used the example of a car. Before tariffs, let's say you had to pay $5,000 for a down payment on a car. Tariffs come along and you have to spend $7,500 on a car, and you had $10,000 total, to spend. Before tariffs, you have $5,000. Now you have $2,500. So again, what that means is that you're probably not going to have. You're going to have to choose not to spend some of that money on something else, meaning cinemas, booze, whatever. Enjoy yourself, restaurants. Okay, so and because the household is likely, individuals are likely at that point having to battle with, balance sheet compression, if when you want to use fancy words. The same applies to businesses, because people are kind of tapped out, if you will. They don't really have a tool to increase the amount of money they have, so they're dealing with the same amount of money and prices going up. It just means they're going to be extra price sensitive, and they're probably not going to stomach most of the price increases that might come along because of tariffs per se. Okay, that means that companies will likely have to reduce headcount. Why? Well, because again, if revenue stays flat because your customers don't have the stomach to, really can't stomach rather, any price increases. So revenue stays flat and prices, input prices go up. The only way you have to protect your margins are, again, by going towards layoffs. Okay? So this is what the quits rate is telling us. And if you put it together, again, it was my initial point with the continuing claims, to me, it's quite consistent. Continuing claims are going up, meaning it's harder to find a job. Quits rate is at cycle lows, meaning that people no longer see the abundance in the economy that they saw in 2022, so they're staying put at their job, and they're really not willing to take any risks because they know that if they take risks, the outcome might look something like this. You end up spending more and more and more time on, unemployment benefits. All right. So today's data did nothing really to change my outlook on that. We also had the Empire State Manufacturing Survey. That was kind of mixed. All right. This had a bit of everything. You had employment edging higher. You had business current conditions worsen. You had new orders fall. But at the same time, you also had, the outlook for the future kind of edging up. And you also had capital expenditure plans go down as well. So it's kind of a bit all over the place. One of the good parts, if you will, is also the prices paid. This was probably one of the first reports where, the inflationistas, oddly enough, did not mention the prices paid category of the report. Guess why? Because, again, it came in lower. All right. So, take that for what it's worth. So this is really a mixed report. I'd like to see, the other regional surveys come out. I'll be paying attention to those, close attention to those. We have the Philly Fed indexes come out, rather index for manufacturing come out on Friday, as well as the PMIs coming out next week. So I'll be quite curious to see, the state of those reports as well before I really say anything too definitive about this report here. Just keep in mind, it has a bit of everything. All right. Probably the summary is the best way to put everything. Business activity continued to contract in New York in June. However, employment grew slightly. Firms also turned positive, expecting activity to increase in the months ahead. So it's kind of, a tug of war dynamic. So let's wait for other reports before really trying to read too much into it. We also got some housing data out this morning, which was quite lower than compared. Housing starts were about 10% lower, if I'm not mistaken. Right here, yeah, 10%, 9.8. I'm not a housing buff. I'm not an expert. I just know that, if housing starts are going lower, that'll probably feed into construction employment, which again is not great. All right. We've actually went close to breaking the lows that we saw last year. All right. So again, we continue to see this kind of slow crescendo, if you will. Again, this process playing out in the economic data. We don't really have the smoking gun, that aha moment where everybody just says, you know what, it's a recession. Close the furnace, close the factories. It's a recession. Nobody's going to buy our goods. We're slowly building up to something like that. And again, I come back to one of my initial points that I made on this channel. Look at the summer. Really, the summer, in my opinion, will tell us a lot about the state of the economy, simply because we know that initial claims like to peak out during the summer. All right, July of 2023, we're at 258. Last year, we peaked out at 248. We're in June now. Let's see how far up initial jobless claims go. I would not be surprised if we breach actually these highs in initial jobless claims. So anything above 260, possibly anywhere between 260 and 290 seems like a reasonable target for the summer for initial jobless claims. Again, I reiterate, my target, I was talking about right here in April and May for continuing claims was anywhere between 2 and 2.1 million. Time will tell if these are, too pessimistic rather, or too conservative estimates. Let's see how the numbers play out. And again, how does this tie back into TLT? I kind of flipped the script a bit, but just to reiterate, if you continue to see the data come out negatively, as we have, and as we continue to see, then time is on your side. I would much rather be in a position where, TLT is basically, boozed out, at the $86 level, with the economic data coming in lower and negatively, and having that as a tailwind, rather than being up here and the economic data starting to turn positive, all right, which is actually what we saw in 2024. As September rolled around, everybody was kind of looking at September for that confirmation of a recession, which never came. And again, we got the opposite. We got, growth picking up, because again, a lot of, transitory events, again, pulling out the T word. So again, I would, if you're looking and considering opening a position in TLT, know that you need patience. All right, this isn't your altcoin that goes up by, your crypto gem that goes up by 1,000%. You're not even going to see 1%. All right, keep that in mind. In a good day these days, a good day is a 0.3% increase on TLT. All right, that's a good day. And I forgot what I was about to say. Point number 2. So have patience. And point number 2. Look at the data. Look at the data. That will be your best ally, because you're gonna have, still at these price points, you're gonna have a lot of narratives, a lot of narratives where, be it inflation is going to eat us alive like in 2022. And again, I continue to push back against that, because in my opinion, it comes back to the state of the labor market and everything that I've been arguing for months at this point. The quits rate doesn't really tell us that the state of the labor market is what it was in 2022, which is what really allowed inflation to take place. All right. Yes, we had stimulus. Yes, we had QE galore. Absolutely. But what really caused it is that we had an imbalanced labor market. We had demand going up and supply not really keeping up with the pace. That gave employees the leverage in the labor market, that pushed wages up, that made inflationary forces really be able to permeate throughout the economy, because again, people had those wage increases as a tool to face those prices going up. We no longer have that. All right, so to me, that's the most important dynamic playing out right now, is the state of the labor market, which is again slowing, it's cooling, as again extrapolated from the quits rate, as you can see in the continuing claims, as you can see in initial claims. And again, just to hit on inflation once again, all right, we've heard that tariffs are going to be inflationary, and it's going to be, inflation. We've had tariffs on for a couple of, really, April. We had kind of the fear of tariffs, and so everybody continuing to front run. We had May, tariffs on. And for the time being, at the very least, we haven't seen this huge spike up in inflation. All right, now I'm not going to call a victory on inflation just yet, because again, I'm open to the possibility of having some kind of a spike, of adjustment rather, price adjustment in inflation because of tariffs. Because again, if you built up inventories and you work through that inventory, whenever it is, you're going to have to buy at tariffed prices. So I'm open to the idea that we have a leveling up in CPI, but for the time being, inflation is really not really the main story in my opinion. The market continues to make it the main story because of 2022 and what I call inflation PTSD. All right. So again, just to go back, look at the data. The labor market in this moment in time, in my opinion, is a tailwind for TLT. This doesn't mean that it just has to rally by 3% today or next week. It just means that as long as the economic data is working in your favor, eventually the bond market will wake up. Eventually, whenever that is. Okay? Just like it did in 2023 when it had to wake up and face the music that we weren't going to have a recession. Just like it had to wake up that rates probably, that inflation wasn't well behaved in 2024. Just like it had to wake up to the fact that we weren't going to have higher for longer. Oh, wait. Again, we're going to have a recession. Oh, wait. We're going to have, all these events take place that'll make the economy look better than it actually is. Oh, we're going to have stagflation. All right. Eventually, if the economic data continues to play out the way it is, that will be a tailwind to TLT. What are things, just to let me get this stuff off my chest. What are things that could occur? Let's look at the cons first. Policy shifts. If you see the Fed going to QE immediately, zero interest rates. Like today, we have the Fed coming out with a rate decision. Let's say they come out with, well, we're cutting rates by 450 basis points. We're going to do QE. At that point, you can expect TLT not to react in a positive manner. Why? Well, again, that would just stoke, growth and inflation expectations going up. It wouldn't cause the collapse of the bond market. It would just cause the bond market to ask for a higher premium because of all the growth and inflation that they're going to stoke. All right? That is something to consider. What's something else to consider? The fiscal policy. If we see we're potentially seeing Republicans pass this big beautiful bill, what will that do to TLT? Well, first off, there's a lot of drama being painted around this big beautiful bill, in my opinion. Now, yes, would we all like to see more fiscal responsibility? Yes, absolutely. Having said that, again, I'm not a fiscal expert. I don't follow, I'm not on C-SPAN, 24/7 looking at, what the Senate and the House are talking about. But as far as I can tell, there's a lot of drama around, this deficits being blown out, and whatnot. I've read a lot of people, and, my personal consensus that I've reached is that it won't really do much to growth, given the fact that most of it is just, renewing old tax cuts, which again would just maintain the status quo. And it's probably not considering a lot of the tariff revenues. All right. But regardless of all of that, it is a far cry away from all of this. We're going to blow out the deficit. We're going to just have spending galore and whatnot that we had, fears that were in place a couple of months ago. So that is also to consider. And I will also tell you something else. The fact that, excuse me, the bond market is going to price in higher deficits and the big beautiful bill is going to pass and the bond market is going to collapse because of yada, yada, yada. That kind of, and this is an original thought, I heard, again, Neil Dada talk about this quite a while ago. Doesn't that really go against the forward-looking nature of markets? I mean, Trump came in and, he wants to pass his signature bill which he's been talking about ever since he started running for presidency, last year. What are you expecting? All right. To me, with TLT at this level right here, to me that just tells me that it's probably most of it is priced in at this level right here. Again, barring any new, uh, um, you know, developments that just dramatically revise the deficits up or whatever. All right. Um, on the pros side, what are some other events that could affect TLT? The war. The war in the Middle East. I'm a little bit more cautious on that, simply because I think that just to look at recent price action, in particular, this week's price action, in my opinion, is less tied to the fact of the war that we're seeing in the Middle East between Israel and Iran, which again I'm calling a war because again it's not exchanging firecrackers like in April of last year. We're bombing, all right, and we're bombing, all right. So it is a war until it stops. And again, to me, rates going lower isn't really a function of the war yet. It is more of a function of some of the data that we got over the last few days. All right. And again, we continue to see this kind of tug of war play out between, the economic data coming in lower and, the bond market being hell bent on price against stagflation. Oh, oil is going to go up, all that good stuff. So the only way I could see a total risk off play out, if you will, in the 30-year bond and TLT is if we have something very, very bad happen. All right. Let's say land invasion by the US. Let's say nuclear detonation. All right. Some serious escalation. Because at that point, you would also have to consider potential, the escalation risks. All right. Potentially Russia and China might have a play in that, given that Iran is kind of the midway point between the two of them. Iran supplies a lot of oil to China. Iran supplies a lot of drones to Russia because of the war going on in Ukraine. But again, that's kind of the doomsday in me coming out, which again I always try to keep suppressed because again, as I always say, if that something like that happens, you have bigger fish to fry than sitting in front of a computer and wondering what to buy. If in the case of a nuclear war, you don't want to buy bonds or gold or Bitcoin. You want to buy farmable land with a source of clean water and a shotgun to defend it all. All right, so keep that in mind. All right. I maintain the idea that eventually the bond market will wake up in the face of declining economic data, as we continue to see, and as we've continued to see throughout these months. All right, this isn't a slowing that started with tariffs. Trade deals won't fix it. This has been in the works for quite a while. I would argue from last year. I would argue that what we saw last year in 2024 with this bout on inflation right here from September to January wasn't a result of the rate cuts. It was just a result of events taking place in the economy. Simple as that. Tariff fears, tariff front running, port strike fears, natural disasters, exuberance because of presidential elections. And it's just that taking place in the economy. All right. And that the slowing was well underway, probably, I would argue, from April of 2024. And that is also really corroborated by something else I've been looking at. I pointed out quite a few times in my previous videos as well. If you look at the revised numbers for, job gains and job losses, we really didn't do much in, the third quarter of 2024. All right. It was kind of frozen, if you will, in the first half of 2024. And as we move into the new year, we continue to see that frozen state potentially, again, slowing down even further. All right. So I'll keep it at that. I'll end the video here. As usual, this is a 40-minute video. All right, I don't even pretend to say this is going to be a quick one at the beginning at the beginning of the video, because I know that isn't going to be true, not by a long shot. So again, just to reiterate, as far as the chart is concerned, we're in a falling wedge. We could see a fake out to sweep the previous low of 2023. That doesn't have to happen. Just keep an open mind and keep something on the side in case it does happen. If it doesn't happen, we have to give more and more credit to this secondary low right here that we put in the week of May 19th, which would basically put us in the 2010-2011 scenario with a slightly higher low compared to the previous one, as opposed to 2006, 2007. And it would actually just pour fuel potentially, on TLT's, on TLT, and just fuel it to break out of this wedge. And if we do break out of this wedge, it will likely mean that either, again, some geopolitical event occurred, something bad happened around the world, or simply put, we had economic data coming in lower than expected. And if we do, my first target, again, as I said, I think I spoke about this in April. Regardless, my first target would be somewhere around $107, $108, $105, something like that, which would put us around, this level right here, where we were in the local highs of 2023, around these levels of 2013, and if you will, the peak of August of 2010, and also this local high in March of 2009 as well. So that, as far as the chart is concerned, again, my base case hasn't changed. The data continues to be a tailwind to TLT, not a headwind as it was, from September till, I would argue, till February, really. And it's only going to be a matter of time before the bond market wakes up. Because again, bond market likes to, fixate itself on a lot of things, recession in 23, higher for longer, growth scare, stagflation, whatever. The bond market has said it all in this cycle. And as far as the economic data is concerned, initial claims continue to spike up. We're at 245. That just tells me that the next employment report is going to likely be up. Continuing claims, still up. And if you put that together with the quits rate, that just paints a picture of a labor market that has cooled off significantly compared to 2022, meaning people no longer see the abundance that they saw in 2022. They're likely to stay put at their job because they don't see the abundance that they saw back then. And again, that just means wages are, and again, if they're not going to take risks, because again, they see what happens, meaning you're going to stay unemployed for longer. And because of it all, wages are going to stay stagnant. And if wages stay stagnant, businesses are going to wake up to that, and likely they're not going to be able to pass on as much of the costs coming from whatever inflationary bout there is, be it tariffs, oil going up, whatever, to customers, meaning that in the face of flattish revenue, prices going up, the only way you have to protect your margin is really to resort to layoffs. That to me is really why I'm bullish on TLT, still bullish on TLT. It just takes a lot of patience. All right, so I'll leave it at that. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.